Everyone's buying Meta at around $600. The trade I sent my members allows you to own it for about 14% cheaper, pays you $85 to enter, and it carries over $2,500 of upside. And it's already showing us about a $550 profit. Soon, I'll show you the exact order on screen. The same one my Trade Alerts members received on July 8th. No predictions, no price targets. Just a structure that wins whether Meta goes up, down, or sideways. Because my job is simple. Win when you're right, win when you're wrong, never gamble. And stay till the end. I'll give you the exact strike prices to run this with strictly defined risk, even in a small account. Why Meta? Facebook, Instagram, WhatsApp. Half the planet opens a Meta app every single day. It's an advertising machine funding one of the largest AI buildouts on Earth. The question isn't if you want to own it, it's whether you should pay full price at $600 plus. Why I'm not just buying the shares. When you buy the shares, you win only if the stock goes up. You can pay around $600 per share today, but you have no safety net and no cushion if the stock dips. This trade, you get paid $85 to enter, you win up, down, or sideways, you have a built-in 14% discount if the stock drops, and you're able to participate in the upside if the stock goes up. Never traded options before? Here it is in 20 seconds. Selling a put equals a buy it on sale order below today's price, except you get paid cash today just to place it. If the stock never drops to your price, you get to keep the cash. If it drops to it, you own one of the best companies on earth on sale. Basically, you get paid to be patient instead of paying full price today and hoping that it goes up. My finance bull trade on Meta, and I'll show you the exact screenshot shortly. Here you'd buy the 630 by 655 call spread. This will give you $2,500 of upside potential. Then you'd finance it by selling the August 2026 $525 put. This is a price I'd be thrilled to own Meta at. It's about 14% below where it was trading when I sent this trade to my alerts members. The whole package opens for a credit. You get paid $85 just to enter this trade. Most people pay to buy a call option, but you'd have gotten paid to enter this trade. The exact order is sent to my members. Here you can see we sold the August 2026 525, and then we bought the call debit spread. And right now it's showing about a $550 unrealized profit. This was sent to my Trade Alerts members on July 8th at about 9:35 a.m. in the morning. Quick, don't go anywhere. Here's the plain English version of what you just saw. You'd be paid $85 today. If Meta runs higher, the call spread profits up to $2,500. If it drops, you'd buy one of the best companies on earth about 14% off. If it does nothing, you get to keep the cash. And a few weeks into this trade, this one is already showing us about a $550 profit. And in about 90 seconds, I'll show you the exact strikes to run this with strictly defined risk, which is perfect for smaller accounts. How this wins, up, down, or sideways. Up, the call spread profits up to $2,500, and you get to keep the initial credit. Down, if it falls down to my strike price, I get assigned at $525. This means we own Meta at about 14% discount, which is a price that you chose, and you get to keep the original credit. If Meta only trades sideways, then you still get to keep the original credit. If you pay full price and you buy the shares now, you only win if the stock goes up. But let's say you want to own it. And what if it keeps running higher? If you want the shares, if Meta falls to 525, you do own it, roughly 14% cheaper, and you still keep the credit. Worried if it rips higher? The call spread profits all the way to its cap, and you were paid to enter the trade. The only thing you give up are the gains above the cap. For a company this good, that's definitely a trade worth making. You get to own it at a big discount if it drops, you get the upside if it runs higher, and you get paid today either way. Why getting paid to enter is the entire edge. Most traders pay for a call option. They need to be right on direction and timing. This trade opens for a credit, and time passing and a flat market, they both work for you. That's why this one is up about $550 without Meta doing anything heroic. You don't need predictions, you need a better structure. The number one mistake that ruins this trade. This only works if you genuinely want to own the stock at your put strike. Selling puts on a company you don't want equals gambling for premium. Pick the company first, the strike price second. The discipline is the edge. The honest risk. Let me be precise. This is not a defined risk trade. The put is naked, which is undefined risk. If Meta craters far below 525, then you'll get assigned and forced to own it above the market price. That could be a real loss. That's why you only sell puts on companies you'd happily hold for years, and why the defined risk version is only 60 seconds away. Real accounts, verified statements. Around 2.8 million in total verified portfolio via E-Trade. You can see our year-to-date performance, and this trading strategy outperforms during market pullbacks. In March 2026, when the market was down around 7 or 8%, this account was down less than 1%. By becoming a member, you'll receive my real trades in real time sent directly to you via WhatsApp. The real lesson. Nobody predicted Meta. We didn't have to use any charts. The structure was simply pay to open the trade, and it's up about $550 either way. Up, down, or sideways, the trade wins in more than one direction. Win when you're right, win when you're wrong, never gamble. The defined risk version. Here are the exact strikes. Are you nervous about a naked put? Same trade, strictly limited risk. What I would do is I would sell the 525 put and I would buy the 430 put. The max risk drops from $5.25 per share to $95 per share. And I would also keep the same call spread. The $2,500 of upside doesn't change. Looking back on this, I want to make a small edit. I would actually sell the 545 put, be a little bit more aggressive. That way you can collect more premium. Then instead of selling the 430, I would sell the 460. That would narrow the risk of your put spread even more. The benefit is by selling the higher strike, I'm able to collect more premium, which would allow me to pay for the long put and therefore turn that into a put spread with defined risk. That's the trade, already showing about a $550 profit and a winner whether Meta rips or dips. Who's telling you this? I'm a former Wall Street investment banker, Morgan Stanley, CIBC World Markets, and Petsky Prunier. Ivy League graduate, 10 plus years trading options full time. Want every trade I send my members in real time? The 14-day trial link is in the description. Tell me in the comments which stock I should run my finance bull on next. Apple, Amazon, Tesla, or another stock that you prefer. Your pick could be the next video. Win when you're right, win when you're wrong, never gamble. And click on the video that's popping up on your screen right now because YouTube believes that you would enjoy it the most.